I'm one dumb idiot, but I think I have finally wrapped my mind around at least part of what's causing the world consternation with the yen carry trade. Let me explain. One of the things I never understood about the yen carry trade was that if one borrowed in yen, swapped the yen to dollars, and then if all of a sudden the yen depreciated against the dollar, let's say from 100 to 150, would that not be a net gain? In other words, the people who borrowed the yen to turning it to dollars would be short yen and they're holding dollars. And so therefore, if the yen has fallen from 100 to 150, they really have realized a gain of, let's say, 50%. In other words, at least in dollar terms, because they only have to send back half the dollars to repay their yen debt. I was trying to reconcile that with why the yen falling was so bad. And this shows, how ignorant I was in the situation. What I missed was, and this is what I think the answer to my question was, a duration problem. In other words, I had just simply assumed that if one had borrowed in yen, let's say for a week, and then they had parked the cash in USD for, let's say, a week, they could just simply unwind the trade at any time they want. And particularly, let's say if they're 3 or 4 days into it, if you had a major move in the currency, then why wouldn't you unwind the trade and capture the difference? The problem that I think I missed, and shame on me for missing because it's so obvious, was that, well, Justin, if you're borrowing yen overnight and posting the yen as collateral to borrow dollars, but in turn, if you've spent the dollars or you've taken the dollars and invested them in something else, let's say, 10-year treasuries, for example, or something else, well, sure. The problem that you're running into now is that you have to keep rolling over the yen day after day after day because you borrowed on an overnight basis. Essentially, you have a duration mismatch in this regard. And likewise, the reason you just simply wouldn't sell whatever asset you bought with the dollars is that you might not be able to sell whatever asset you bought for the dollar. So, for example, let's say you bought treasuries and let's say the yield spiked to something where you'd be looking at a loss. Well, sure, you could sell whatever that asset is. You'd be selling it for less. And when you, even with the currency exchange, tailwind in your favor, you're still going to be running into problems in that regard. And if you compound that with interest rates rising in Japan, not only do you have to borrow more yen in an overnight basis, because you have to provide the same amount of collateral to support your USD loan that you've taken out on the other side of the trade, but at the same time, you're paying more for that. And I don't know if this is correct, but this is the best way I've been able to cobble this together. And shame on me for being so obtuse on this, because I was scratching my head. I think I was even talking to you, Josh, about this too. I was like, why is this a bad thing? Because if people are short yen and they've turned it into dollars, and if the dollars appreciated against the yen, like, isn't that a win? But then only when I put through to myself, well, Justin, if you turned it into dollars, but then you spent the dollars on something else, you bought treasuries or you parked the cash somewhere else. But the point is you parked it somewhere else where you're not going to be able to get the cash back readily, or to get the cash back early, you're going to have to pay a stiff penalty. Well, you've got a problem. And the problem's compounded. Just as you would have a gain on the initial loan in terms of when you repay it back, you also have it working against you if you have to keep borrowing more and more yen in the overnight basis if the currency exchange goes against you. Does that make sense, Josh? I feel like I'm not being completely clear.
Yeah, well, yeah. So the way that I kind of see the yen carry trade is, well, the yen has very low interest rates. So what you would do is you would buy Japanese yen, which has historically low interest rates until very recently, and then you would convert that into other currencies like dollar, Aussie dollars, euros, to then go and park those funds in higher yielding assets like government bonds or stocks. But I think the main issue that we're running into is, one, the dollar starting to go up. So when you convert into those yen, which historically had very low interest rates, you are going to have to raise more money to get those dollars. So there's a mismatch going on, as well as now the Japan is actually hiking interest rates. So the math
Yeah.
just doesn't work as well as it used to.
Gotcha. And the way I think this was my big thing, this was kind of like my epiphany. Well, and like it's said all the time. I'm like, I can't believe I was so stupid that I didn't figure it out. Is that, listen, if you're borrowing overnight, that's just it. You're borrowing overnight. And sure, you might have a good relationship with whoever you're borrowing yen from on the other side of the trade. But the point is that like if you needed enough, but to borrow enough yen to supply collateral, just these numbers out of my backside here, to support $100 million USD position. Well, if it's 100 to 1, oh, shoot, math is hard for me to do, it says the accountant. My point is that like if every day you have to renew your yen borrowing and your yen serves as collateral to support your USD borrowing. And if suddenly the USD appreciates against the yen, or said another way, if the yen falls against the USD, then you have to borrow more yen to support the same amount of USD. And you might not be able to reduce the amount of USD you need to borrow because you've already deployed the amount of, or you've already deployed the USD that you've borrowed, hence the duration mismatch. If you haven't deployed, or assuming your USD asset isn't necessarily invested in an overnight rate, then all of a sudden you're kind of forced to continue the trade or perhaps close out the trade early at a loss. Hence, the problem, as you accurately noted, Josh, you've got it on two fronts now from the yen side. Number one, if you have to borrow more yen to support the same dollar borrowings because the yen's following against the dollar, that's problematic. But at the same time, too, if you're having to pay more, let's say it's gone from, what was borrowing in the yen, like 5 basis points?
Something stupidly low to now
Yeah.
it is higher. And
Yeah,
even
it's
though on
1%, right?
an absolute basis, it is still incredibly low relative. If you were running this
Yeah.
trade for the past few years, now on a relative basis, the cost is through the roof. So the math doesn't make sense anymore.
Yeah, and that's my point too. Is that like if you basically, because what I think's going on is I think you've got an arbitrage play, and again, like I want to be really clear, like I am not a trader, like I am fumbling my way through this, but like if you can, well, no, but hear me out, but like
No,
if
no,
you can borrow. Yeah, if you can borrow like 5 basis points overnight in, let's say, Japan, and invest, let's say, 100 basis points to 1% in dollars or whatever, right? But let's say you have to go out, let's just say a year. You're having to buy a 1-year treasury in this regard. Then all of a sudden, okay, well, that works as long as you don't have any major change. But let's say if the borrowing rate suddenly, or let's say the interest rate to borrow yen suddenly goes up to 1%, well, all of a sudden now you're losing your spread. And the second thing on that front is that you also are now having to borrow more yen, and so your costs have started to go against you in these
you're
two
getting
ways.
fucked on both levels.
Yeah.
And the problem with these types of short vol arbitrages is it takes a very small volatile move for it to go against you in a huge way, especially if you were just trying to pick up a few basis points. What you would do is you'd use a lot of leverage. And if you have to unwind that position, a lot of leverage with a lot of volatility is not too good.
And you know what this seems like, Josh? Like I know I feel like I'm a broken record on this. I should just change my name from Justin to, boy, this sure does sound like LTCM. But my point though is that like I was listening to so Rickards in Road to Ruin. It's one of his, I think, book 3 of his 4 books, but don't quote me on that. It's one of the 4 books. I think it's the third. He basically talks about the LTCM debacle and what was going on at the time. And I was actually just listening to this on the drive home the other day, where
What's amazing, Justin, is there are millions of books out there, but you love to reread the exact same chapters of the exact same
It's
books.
true, and it's the same thing with video games.
Yeah,
it's the same thing with the games. I play the exact same damn games over and over and over again. Well, anyways, that's a separate video. But my point though is this, Josh. Like when LTCM blew up, ultimately what happened was it started in like September or so. Q3 is what I recall, and there was a similar thing that was going on. And now I'm doing my best to be accurate here, but I'm not going to be accurate. But this will get people in the ballpark if they care enough to research it on their own. There was a similar situation with the Thai baht that was going on, where I think Thailand had pegged their currency to the dollar and had low interest rates. So the point is that you could borrow Thai baht very cheap and you would exchange it into something else. Something happened in Thailand where the peg broke. And this ultimately started off a series of events that ended up in Russia. And this is when Russia defaulted both on their internal and their external debt, which basically screwed over LTCM. LTCM being screwed over basically highlighted the fact that we don't necessarily know who, or the counterparty liabilities are running into an issue. Consider our prior videos, Josh, where we've talked about CLDL. You could say that the fundamental flaw, if the 2 original sins of the Eurodollar system we have right now started in 1917 with the Fed, and that's with the concept of repo masquerading a collateralized loan, as well as rehypothecation thereof because title will transfer, then you could say that if that was, the evil mom and that was the evil dad, the evil bastard that, was birthed from this was the fact that we can't prove liabilities. And again, I'm about to violently derail into a separate video, but this is why I think it's so important to have a CLDL, a centralized digital liability ledger, where you're able to see, where firms can see, and so can, the investing public can see, okay, well, listen, just who's on the hook for who, because I think the problem that we're going into right now, whether you want to talk about something like COMEX shorts on silver, whether you want to talk about something like GameStop, or just anything in general, nobody has any idea of the liabilities of anyone else, particularly when the liabilities are treated in a way, legally, of course, and within whatever, I'm sure, guidelines of compliance that are relative and applicable, where you can basically, where institutions can't, I don't want to say hide, but can report and distort such liabilities. But anyways, going back to the yen thing, that was the key thing is I wasn't understanding, or I hadn't, shame on me, but I hadn't made the connection between, well, wait a minute, if you have a duration mismatch and you're having to constantly roll over yen to support your dollar borrowings and the dollar goes against you, or that is, if the yen falls against the dollar, well, all of a sudden you're having to borrow a shit ton more yen, theoretically, in order to support your dollar short, and you'll not be able to close up the dollar short because whatever asset you bought with the dollar short, trying to do an arb play, which I would assume is, what the majority are trying to do, you might not be able to do it, or at least you might not be able to do it yet without incurring a major loss.
Yeah, This does not mean anything is imminent. I'm only really 50% sure of what's going on with the yen carry trade. And short vol works very, very well, just until it doesn't. And we are
Yeah.
starting to see volatility start to pick up. Will it continue? Who knows? I mean, I'm not making any decisions based upon this information. It is simply a fun thought experiment to think through what could happen, but there are so many more complexities that go into this. Who knows if people are even leveraged up on this? Just kind of food for thought.
Yeah, and let me just add one other thing too before we close out here too. Like traditionally, the signals that I would look at to try to like make sense of things, like not that I was particularly, the smartest person there, but I like to think I at least tried to be informed, right? Like, hey, well, in general, this should happen. In general, that should happen. If this happens, whatever. But the other thing that I find fascinating about all of this is how the metals, and maybe this is again a separate video, but what the metals have done, because I just look at it and like if I think they should go down, they go up. If I think they should go up, they go down. If I think they should stay flat, they kind of stay flattish, but violently flattish. And like I just well, in any event, I suppose like my only insight and my own wisdom is I just become more and more aware of my own ignorance, which I guess is a step in the right direction, albeit a frustrating step at times.
Yeah. Uh, there's way too much nonsense that I see with people saying, do this now. There's a collapse coming instantly. I just don't see that coming. Imminent can be a multi-year process because things take so long to play out, and that just happens very quickly. But I've been wrong on a lot of things just because my time duration, I was
Yeah.
expecting, let's say, as a 6 to 12 month time horizon, and maybe it plays out on a 5 year time horizon. But that's not when I was thinking through that situation. That's not what I was putting on. And I mean, me and Justin talked about a lot of things that haven't happened. So this does not mean anything actionable, I would say.
Yeah. And what I will say, I will stand by my original prediction, which I still think has proven right, but that's because I made it in a very schmarmy way. I think the existing system will go on far longer than anyone thinks it can go on, but I also think when it collapses, it'll collapse far quicker than anyone thinks it can collapse. In other words, I said absolutely nothing. The sky is blue and water is wet.